Welcome to another Wealth Coffee Chat. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well. Hey, good morning, everyone. Welcome along. Good to see you. A few of the early birds up and at it already. Good to see you on this morning, James. How you going, mate? Stephen, good to see you. Stu, how are you, mate? Haven't seen you for ages. Hope you're well, buddy. Hope you're well. Brad's in the house as well. Hey, good morning. Whoever you are, you must know me. I don't know your name, but if I do know you very well, then good morning. Fabulous Facebook user. Hey, another one there. Good old Facebook doesn't show the names if you're in the groups, but that's okay. Fantastic to have you here. Good to see you all, folks. That's awesome, Stu. Let's get into it. Let's warm the old wheels up as we get going this morning, Thursday. If you didn't already know, most of you do. I always do the quick intros just to make sure. Jason Whitton's my name. And welcome along if you're new. We've had a few newbies of late. We've had a fair few people joining our coaching and mentoring program, which is awesome and amazing. So if that's you, let us know in the chat. We do this 10 past 8 each weekday. Make sure you subscribe and get the alerts and so on if you want to catch the lives. Or they are recorded, folks, and they're turned into podcasts and vodcasts and all sorts of content that you can catch up on at a later stage as well. So if daylight savings is a bit of a pain, then maybe you catch the replay. Anyway, there you go. Oh, that's awesome, Stu. Good luck with the settlement today. I'm sure it'll go well, which is awesome. Let's have a bit of a yarn today. I thought we'd talk about, yesterday we talked about growth, right? We talked about the drivers of growth when it comes to our property portfolio, folks. And we went through Sam's 4x growth plan. The idea that you can do a deal and it has some inherent growth when you purchase the thing, or you can do something to it in a 1 or 2 year period and push growth, like force growth. There's the location of the property. There's location growth in your real estate. There's market growth, and market growth is where the majority of the growth comes from, where the inflation and population and infrastructure and money and all sorts of stuff drives the growth, the most growth in real estate over the medium to long term. And then, we talked about the fourth driver, which is the overdriver, the overvalue growth, things that can push properties more than the regular thoughts or properties when it comes to the behaviors, the styles, the designs, the desires of that property and its location and other bits and pieces. So all of those four pieces apply to rent growth also, folks. So they also apply to your rent growth. Can you do something the day you buy a property? Yes, you could renovate and the rent go up. All of those things apply. But I wanted to talk about, some other things when it comes to, rent growth this morning. Morning, Chris. When it comes to our property investing. So let's get into it today. What's going to drive our rent growth, over time? And the the things we need to keep an eye on, sort of short, medium, and long term when it comes to our properties and the things that we do, and how we invest. You guys have seen this before. This is our 3 stages of investing: the acquisition stage, the consolidation stage, and we call this the lifestyle/legacy stage. Where hopefully we get to enjoy the spoils of our efforts at some point in the future. And it takes a little bit of time to get there, but over time, your values increase. You want your rents to increase as well, and ultimately, folks, you want your debts to go down, right? That's the drill. If I was to explain it in one simple diagram, over time, right? Over time, this is it. It's really simple. Buy some properties that go up in value. The rents hopefully go up too at some point, sooner rather than later. The crossover between the rent covering all the costs and reducing the debt takes over from your pocket. So for most of us, we have to put some money and some capital in. We have to put cash in to get this thing started, right? So, we have to put either equity, cash, and or cash flow into the stuff to get the ball rolling. But over here, later on, this is where we get to take some cash out, right? This is where equity and cash comes out. It flows into our world, and, we can start to, benefit from that. The in that we put in comes back, and it's a really interesting one when we talk about this. This is quite interesting. I talk about this all the time. What happens, a lot of property investors forget that if they put $100,000 into a deal and they're able to refinance that money out of a deal in this sort of section here, acquisition is all about the purchasing of a property. The money that comes back, I'll just give you an example right now. I put a couple of $100,000 into a house that I'm building up in Brisbane. All up, it was close to 780, 770 something, 778 or something. And now the valuations come back at 1.2, and I'll be getting every cent of my $200,000 back that I put into the property, no money in. So my return on cash is 100%, all of my money back, and now my cash flow and return from that property will be pretty sweet. So 100% cash on cash return, my capital return, and now in that deal, the returns on that deal now are exponential. Because there's no cash in there. I just need the cash flow to run. So we put stuff in and we get stuff out. How can we see this section here? This section here where the crossover, the part where we want our, maybe our properties to go from negative to positive cash flow. Cash flow, the sooner it can, take the weight off your pocket, the sooner it can produce a little bit of extra cash flow and cash, the better, right? So the better. So how can we make this happen faster? The first sort of 0 to kind of 7 years is acquisition, 7 to sort of 10 years usually is kind of that consolidation stage. And up here, sort of, what I say all the time, it's like a 15 to 20 year window. So today, really, most of the conversation is going to be about this stage here, this consolidation stage, when we talk about the rents. The rents. What can we do? What needs to happen in that stage? And that stage, the consolidation stage, is absolutely, Tim, keep your borrowing costs as low as possible for sure. Always, always, always. I do it every 12 months, but sometimes every 6 months is worth doing. Check your equity and then check your interest rates, all right? When it comes to your lending. Navigating your lending is so important continuously. But this middle stage, right, the consolidation stage, I have got another name for it, or called the triple M stage. The triple M stage, this is all, interesting jargon anyway, but, what is the triple M stage when it comes to the consolidation stage. Well, anyone want to try and guess what the 3 M's might stand for? I'll get into it today because, I always end up sort of rabbiting on, running out of time. But, the first one and this middle stage in the state of is for you from management. That means in a second, right? And now this, it might sound like I see so many people not maintaining their properties, and they're not. These aren't linear. Your property is vital, and we'll talk about that. And rentability or its rental potential is also vital as well. First two, absolutely required for what we want. So tell me in the chat, manage. Number one, give me a few suggestions. In the management stage, the manage stage, what do you need? Absolutely vital, a good property manager, a good property manager. More importantly, folks, probably a good property management company or office where you have your properties, because property management, by and large, is quite challenging industry. Certainly, it attracts a lot of younger people, and sometimes it has a bit of turnover. So you want to try and find a property manager that's mature, that's got some experience, and a business that is very keen to maximize and manage your property well. What do I mean by that, right? So a property manager, not only do they need to do, the inspections, they need to make sure the rental checks are going on. Most property managers, manager PMs, exactly. Most property managers are not great at analyzing the market, right? They're not looking at the stats and the data and whatever. Find one that does that, because if you can put your rent up $50, but you miss that opportunity and the lease renews at a lower rate, $50 times 52, that can be quite significant amount of money over the year. And if you compound that over 15 or 20 years of ownership, that's that's pretty significant. Yeah, communication, the comms, what comes out, are they across the legislation, right? Legislation. Do they do proper tenant checks? All right. The tenant checks, making sure you get a good quality tenant. The managed part of it is so vital, but often overlooked. One of the other parts that I think are really important, you've got to be careful with the managed part of it. Does that company also sell residential real estate? And you've got to be very careful that the lines don't get blurred, because the property management team and the sales team are kind of looking to get more sales listings because they make more money out of selling rather than property management. So there's a few things there you've got to make sure you keep an eye on. The manage. Your property manager, absolutely vital. Rental increases, the legislation, choosing the tenant, communication, and the list goes on, okay? Now, to be honest, the PM is vital across all of these, absolutely vital across all of these. So you can kind of layer this as you go, all right? What's the maintain part? What's the maintain part? Well, this is pretty important. For you as a property investor, I prefer to buy new properties. I don't want to, manage bloody secondhand properties. It's a pain in the ass. I've done it. And I can tell you right now, my experience now, just by brand new, warranties, guarantees, the lot. Anyway, that's just me. But if you have an older property, or your property starts to get tired or things break, maintaining that is vital, folks. A couple of things. Yeah, exactly. So a couple of things with maintenance. Now, if something breaks, let me ask you in the chat here. Let's say for example, the oven breaks. Let's say the oven breaks in someone's house, in your rental property. How fast do you need to replace that, or should you replace it, folks? Put that in the chat for me, right? The oven broke, right? How fast should it be replaced? How fast should a leaking tap be replaced? How fast should the broken toilet seat be replaced? Exactly, Tim. Exactly, Brad. Immediately. And I see this all the time. Not that much from our clients at Positive, but those who are not very good landlords, they might spend a week getting all the best quotes. They say to the property manager, "Oh, listen, get me 3 quotes and send me an email and I'll get to it on Friday." No, that is terrible, right? Bad landlording, all right? How do you do that? You don't hesitate. Exactly. Replace everything straight away. Your tenant is your partner in wealth, folks, right? And this is I completely disagree with a lot of people's attitude about, bad tenants and stuff like that. Yes, there are tenants that are undesirable and you need to manage that. But you know what? Your tenant is your partner in wealth. They're paying you the rent so you can own a property. So make sure you appreciate that. If something breaks, replace it ASAP. What I do is I give my property manager, don't even ask me for anything under $500. Just get it done, right? Get it done. $500. Don't even ask me. Don't even ask me. Anything over $500, send me a text, and I'll respond immediately. All right, that's right. Better quality properties get better quality tenants. Exactly, Alison. Not only will you keep better tenants, and you'll end up with a better income, folks. If you maintain your properties systematically over time, you do small upgrades, replace the carpet, lights, whatever. What I see is, let's say over time, let's say this is 10 years, and you do very little maintenance, then at some point you have to spend a whole lot of money, and this might be like 30, 40K in one big go if you haven't maintained your property properly. And you might have to spend a big amount of money up front, or in one go, you might have weeks and weeks of vacancy, and it creates more of a problem. If you maintained your property a little bit as you go, right, then you might only have to spend 10K on a bit more of an upgrade to keep your property up to speed and earning the money that you want in that marketplace. Maintaining your property is absolutely essential. Absolutely essential. Last one is always the fun one, right? The fun one. How do we maximize, team? How do we maximize your property and really, kick this thing out of the park? Well, there's some few cool things, right? How do you maximize it? For me, for you, there's a few ways. And most of us will have an existing property, so you can add a value, like add, let's say, a granny flat, right? A granny flat. Add a second dwelling. Rent by room. I know a lot of people at the moment are doing some rent by room stuff and getting quite a good amount of income out of their room. You can short let. So else. I think that's one of my properties, I fully furnished it, and the rental yield is like 6.9, 6.7%. Like it's just close to 7%. Like it's fantastic. So, what can you do? What can you do to maximize your rental? You know, once you have that property, add something, add an income stream, add a granny flat, add a second dwelling or something like that. Maybe a knockdown rebuild into the future, but you know, that might be, or develop it with a maximize strategy. But you know, maybe rent by room, short letting, Airbnb, furnished, etc., etc. All right. So there's some things. Your PM needs to be helping the whole time. These two are the most important in the early days, right? This great management and maintain your property well, because your property will fall behind the market. It falls behind the market and then it starts to decline. And then, you know, folks, you know, your property manager then struggles to feel excited about your property as well, right? If you give a property manager a really, you know, average property, you know, it's human nature, folks. You know, they'll work on something that's easier and more fun than working on something that's pretty average, you know, attracting average tenants. You know, they're people too. They'd prefer to work with, you know, better quality humans in life, just like you would. So, you know, your property managers certainly, you know, are excited to work on good, well-maintained properties. That's for sure. All right, that's it from me today, folks. Hopefully that was useful. Yesterday we did growth of property values. Today we're talking about growth and maintenance of our rent values into the future. And we'll continue our little journey on this deep dive into the strategies and the tactics and the process of creating and understanding our property investing. Tomorrow, I'm not here tomorrow, having a day off tomorrow, folks. And I'll be back on Monday next week. Is it Monday next week? Yeah, I think it is. And then we're going to start to do some awesome things, which is bring along what we call our 6-star team to the Wealth Coffee Chats in the morning. So we're going to get the 6-star team in and giving you guys an update, a heads up, a bit of a chat about what's going on out there in the marketplace. All right, well, that's it from me, folks. Thanks for joining. Appreciate you being here. Stephen, Allison, Brad, Aaron, Tim. Who else was in the house there? Fritz, Sanjeev, who's ever still around. Jeff, Luke. There you go. There's a few people on this morning. Cole, Stu, thanks for joining, folks. All right, that's it from me. Adios, team. Take care and see you tomorrow. No, you won't see me tomorrow. Sorry. See you on Monday. All right, I'm having a day off tomorrow. Bye. See ya.